U.S. CPI in the spotlight as dovish Fed bets fade. Inflation in the United States has generally been trending lower, but the progress to get it all the way down to 2% has stalled in recent months, at least according to the CPI metric. Whilst Fed officials are optimistic that price measures will continue to head lower over the next few months, the resilience of the U.S. economy is proving to be a thorn in the side of the Fed, as strong domestic demand increases the odds of inflationary pressures brewing again, particularly if there's a significant re-acceleration in wage growth. The Consumer Price Index rose to 3.4% year-over-year in December, having been hovering above 3% since last July. There was somewhat better news for core CPI, which eased below 4% year-over-year for the first time since May 2021. The picture for PCE inflation, the Fed's preferred measure, is a little more encouraging, especially on an annualized basis. Headline PCE stood at 2% and core PCE at 1.9% on a 6-month annualized basis in the last 2 months of 2023. This may have contributed to the market's exuberance in anticipating an imminent dovish pivot by the Federal. However, Fed officials have overwhelmingly signaled that a rate cut may be some time away, giving the US dollar a leg up as investors priced out a March move. Tuesday's CPI print could be crucial in determining whether easing expectations will be pushed back further, as investors still see a strong likelihood of a rate cut in May. Forecasts suggest CPI stayed unchanged at 3.4% year-over-year in January. But the worry isn't just inflation not coming down fast enough. The U.S. economy appears to have enjoyed a pickup in activity in January, so Thursday's retail sales numbers will be vital too. The consensus estimate is for a 0.2% M/M increase, pointing to a cooldown from December. In other data, the Philly Fed Manufacturing Index is also due on Thursday, along with industrial production figures for January. Wrapping up the week on Friday are housing starts, building permits, producer prices, and the University of Michigan's preliminary consumer sentiment survey. Inflation in the UK fell rapidly at the end of 2023 before edging up slightly. If both headline and core CPI resume their decline in January, this would come as a relief for the Bank of England but probably not for the pound. However, only the core measure is forecast to tick lower, and headline CPI is expected to climb again to 4.2% year-over-year. Although both policymakers have been pushing back on market expectations of an early rate cut, investors could ratchet up their bets if there's a surprise drop in inflation. But like in the US, it's not just about the inflation picture, as the economy has also been performing somewhat better than anticipated. UK GDP contracted by 0.1% in the 3 months to September, raising fears about a recession. But Q4 data due on Thursday is expected to show that the UK economy avoided a recession and recorded flat growth during the period. Meanwhile, retail sales numbers will be watched on Friday for signs that consumer spending is recovering following an upbeat services PMI. Not to forget about the labor market, where wage growth has only just started to moderate. The employment report for December is out on Tuesday, and any unexpected strength in the jobs market could dampen rate cut bets, lifting the pound. In Japan, the focus will be on the nation's Q4 GDP readings on Thursday. After suffering a steeper-than-expected contraction in the third quarter of last year, economic growth is forecast to have rebounded by 0.3% quarter-over-quarter in the final 3 months of 2023. If Thursday's figures disappoint, doubts about the strength of the recovery are likely to persist, as recent data has been rather mixed amid subdued consumption, although higher exports probably boosted GDP in Q4. The Bank of Japan is hoping that this year's Shunto wage negotiations will spur pay growth and generate more sustainable inflation. But this could be a hard target to achieve even if the BOJ is confident enough to project it, so a sound economic backdrop is essential in adding credibility to its forecasts. The yen could come under pressure on the back of a softer-than-expected bounce back, but an upside surprise cannot be ruled out either, as most businesses have been positive in the BOJ's most recent Tankan surveys.